Hey, what's up? I'm Russ, and I just watched the AT&T Investor and Analyst Day webcast, so you don't have to. This is basically where AT&T outlined their business strategy and capital allocation plans for all of us. Now, it was about a 2-hour, 24-minute video. Link in the description below. I would recommend that you watch the whole thing. A lot of good information in there, but I distilled it down to basically about an 11-minute video with what I feel are the most important things that they talked about. And at the end of it, stick around because Pascal Desroches talked about, which is AT&T's CFO, he outlined their 2023 or the walkthrough of the free cash flow to and through 2023. So really good thing to know about. And I did give this video the Graham Stephan treatment, meaning that if you don't know, every time he takes a breath in, he edits that out because people are busy and we don't have time to listen to people breathing in on their YouTube videos, right? If I had to sum up this webcast presentation in one sentence, it would be that AT&T is transitioning to become a smaller, more focused company centered on 5G and fiber with simple, safe, and fast products. Before we get to that, and let me know if I'm wrong in some of my figures here, but I believe that post-spinoff, which they believe will take place just before the May dividend payment, which is always in the first week of May, that I think AT&T is going to have about a 6% dividend yield. So let me show you how I got to that number. After the spinoff, AT&T shareholders will receive 0.24 shares for every 1 share of AT&T. For every 100 shares of AT&T, you will receive 24 shares. And after that calculation is made, if you have anything that's fractional, like 24.25 shares, you would be paid cash for that quarter share. I do not believe, as is customary, that companies don't pay for fractional shares after a spinoff. So if we use our current price right now of $23 a share, if that is what it is at the spinoff, we take $23 times 0.24, which will give us a value of $5.52 of Warner Brothers Discovery per share. $23 share price minus the $5.52 of Warner Brothers Discovery leaves us with an AT&T share price of about $17.48. Now, AT&T has said that their dividend will be about $1.11. If we divide that into the $17.48 share price, we get about 0.0635. We multiply that by 100 and we get about a 6.35% dividend yield. Now, AT&T has said that they will have about a 40% free cash flow payout ratio as of 2023 is what they're projecting, which is very solid. Leaves a lot of money left over for deleveraging and investing into the business. So what am I doing with the shares of Warner Brothers Discovery? Well, I don't own any pure play streaming or entertainment companies, but it's a really capital intensive and highly competitive industry with the likes of Netflix and Paramount and Peacock and Disney, just here in the United States. So it's really competitive, and I don't like highly competitive when I'm looking at long-term investments. I do like companies like AT&T because their main competitors are going to be Verizon and T-Mobile. So most likely I'm going to sell most of the WBD shares that I receive, and I'll just buy more AT&T with those funds. And now sit back and watch my distilled down version of the AT&T Analyst and Investor Day webcast.
Today, we're focused on looking forward. We're coming up soon on a big transition at AT&T. A more focused company, a more focused management team. We have stated our intent to focus and simplify our company, improve our returns, and become America's best broadband provider. If the economy is to shift from shopping malls, bank branches, movie theaters, stadiums, classrooms, office parks, and medical plazas, it needs robust distributing networking to enable it. AT&T intends to facilitate this transition with America's most pervasive and scaled broadband network. When our first act is done, we'll be a more focused, agile, and capable domestic network leader. We'll be a company with a smaller product portfolio built on the back of fiber in the core metropolitan and suburban areas, combined with a highly capable nationwide wireless network able to extend even greater capabilities in utility than ever before beyond our core. We also are positioned to sustain strong cash flows and a dividend yield near the top of the Fortune 500.
Let's go deeper on our goal to become the best broadband provider in America. It's a bold objective, and I'm confident in AT&T's expertise to deliver. Now, to be recognized as the best in tomorrow's hyper-connected world, we believe the network must start with a solid foundation of fiber. To put this into perspective, today we're consuming roughly 30 times more data in our home than we are on the go with our smartphones. Homes are getting smarter, and they're becoming more demanding environments where flawless, high-quality broadband is required. Let's take a look at a few consumption trends we're seeing in the home. The average household today has 13 devices, and that's expected to triple by 2025. From smart TVs to smart appliances, these devices are consuming more and more data. There's an immense expansion in streaming and gaming, where higher resolution formats, going from HD to 4K to 8K, are becoming more the standard. And that's only increasing. Why? As more occupants in every home shift their entertainment consumption away from broadcast formats to unicast streaming, the demand for concurrent high-quality bandwidth increases. Coupling that with the format shifts to 4K and 8K, the payload soars well over 2x. To us, fiber is foundational to our entire network. We seamlessly plan and operate one large fiber network with multiple purposes or endpoints. Think homes, apartments, small and medium businesses, large multi-location enterprises, as well as our wireless network. Wherever fiber goes, wireless follows. We are choosing fiber to fuel our vision of being the best broadband provider in America. We're investing in a scaled fiber network with a deliberate wireless strategy. By owning and operating both, we have stronger flexibility to be the leader that captures growth by providing high-quality broadband in more places for businesses and consumers.
We've taken a deliberate approach with FirstNet, establishing a dedicated organization who has deep understanding, relationships, and trust with public safety organizations. For those of you who don't know, FirstNet is America's only nationwide purpose-built platform for public safety. It offers interagency communications with unprecedented priority and preemption service. Reaching more than 2.9 million square miles across the country with Band 14 and AT&T LTE bands, FirstNet covers more first responders than any commercial network in the country. FirstNet has rapidly grown into a $1.7 billion business, which posted 60% year-over-year growth in 2021. In the past couple of years, the number of FirstNet connections has expanded to nearly 3 million among 20,000 agencies. AT&T is now the market leader in law enforcement community, and we have recently signed long-term deals with GM, Ford, Nissan, Tesla, among others. We're helping these brands solve next-generation use cases that will make the car a more engaging, entertaining, and safer experience.
And AT&T is uniquely positioned to work with state and local jurisdictions to compete for and win government funds to upgrade our network. Dependable companies that can deploy large-scale next-generation connectivity across the greatest geographic reach are the solution policymakers are looking for.
In 2022, our expected $24 billion in capital investments will be our highest level ever. It reflects in part a shift in our orientation from paying a high dividend at the expense of making investments that deliver sustainable earnings growth. Another priority is to continue to reduce our leverage by using free cash flows after dividends to pay down our debt and thereby achieve the goal we've set for net debt to EBITDA in the 2.5 times range by the end of 2023. As we get closer to this target, we expect our financial flexibility to increase our ability to pursue other ways to deliver incremental value for our shareholders. This includes the optionality to buy back shares or make success-based investments that generate very attractive returns. In the meantime, investors will participate in our expected earnings growth and receive a high credit quality dividend. Our adjusted dividend ranks our stock among the very best yielding stocks in the U.S. Post-transaction, our expected annual total dividends of around $8 billion reflects a payout ratio of about 40% against our 2023 free cash flow outlook in the $20 billion range. Putting this all together, the key financial metrics we expect to measure our business moving forward includes revenue, adjusted EBITDA, adjusted EPS, and free cash flow. These are clear, reliable, and leading indicators for our business. And lastly, as John indicated, our expectation is that the WarnerMedia transaction could close before the typical May dividend distribution date. The decision on our common dividend payout is always made by the board at the time that each dividend is declared. Now, let me provide you a bit more color on our free cash flow outlook. Our newly defined free cash flow guidance is $16 billion for 2022, which compares to about $19 billion in 2021 on a comparable basis. The primary year-over-year deltas include approximately $2 billion in higher expected cash taxes and about $4 billion in higher capital investments. We expect these factors to be partially offset by $1 billion in organic adjusted EBITDA growth and $1 billion in transformation savings. In addition, we expect about $1 billion in lower cash interest and working capital savings. We expect $4 billion in cash distributions for DirecTV in 2022. This is consistent with the combined 2021 cash generation from our investment and our 7-month full ownership of the video business. Now, how do we get from the current 2022 expectations to our 2023 cash flow outlook? We start at $16 billion for 2022. We expect $1 billion in lower cash distribution from DirecTV, which brings us to $15 billion. We then add a benefit of approximately $2 billion. This reflects lower cash interest from debt paydown expected to take place after the WarnerMedia deal closes, as well as some working capital benefits. The balance will come from growth in adjusted EBITDA of approximately $3 billion per year for our core connectivity business, including transformation. Looking forward, this is how you should think about the walk for 2023. Start with the midpoint of our adjusted EBITDA guidance of $44 billion. Back out capital investments of $24 billion and reduce your cash interest assumption by approximately $2 billion. Next, input your expectation for cash taxes. Our expectations are broadly for steady levels from 2022, which we indicated would be up $2 billion over 2021. Then factor in a modest benefit from working capital. Remember that device subsidy amortization does impact revenues and adjusted EBITDA, but from a cash perspective, we've already incurred the subsidy. As our contract asset flattens in 2023, the cash conversion improves. Also, expect the remaining other non-cash items to be consistent with trend. Lastly, add back your expected cash distributions from DirecTV. We indicated cash from DirecTV should be approximately $1 billion lower versus 2022 levels. That should get to our guidance of the $20 billion range. The bigger picture here is that we have taken significant steps to improve the financial flexibility of our business, whether it is the accelerated pay down of our debt through asset disposition, the right sizing of our dividend, the cost takeout initiatives we put in place, or the reallocation of capital towards durable and sustainable growth vectors. We are in a much better place to navigate potential impacts of any macro or geopolitical uncertainties. Speaking about bigger picture, we realize there are some questions about whether we have the right amount of financial flexibility to meet all of our financial obligations. Perhaps this quick exercise can help frame our comfort with the current obligation levels. Let's first start with our free cash flow expectations of $16 billion for 2022. Add back an expected nearly $2 billion from interest savings from the WarnerMedia separation and the absence of 3G shutdown costs. This gives you a better picture of our run rate cash flows of approximately $18 billion. Hypothetically, let's assume our business runs at this current run rate over the next 3 years. In other words, let's not even adjust for any material benefits from growth, cost reduction, or our expectations of a declining capital intensity beginning in 2024. In this scenario, starting in 2023, we would expect to generate $54 billion of free cash flows over the next 3 years. $30 billion of this cash would be distributed to shareholders via our common and preferred dividend, as well as minority interest obligations. What would that leave us with? On a simple, consistent run rate basis, over the next 3 years, we would generate at least $24 billion in excess cash, even if we don't materially grow cash earnings. And if we grow the business as expected and benefit from the tapering of our peak investment levels and benefit from our cost reduction plans, we would improve our excess cash position.
I'd love to know what you're going to do with the Warner Brother Discovery shares if you are an AT&T investor. Keeping, selling, buying more? Let us know in the comments below, because you know where the comments go. Oh, and on this board behind me is the Bridge portfolio. If you'd like to see what we've going on there, head over to DapperDividends.com and click on My Portfolio. And hey, see this little box next to my head? We did a video right there on AT&T and their debt, how some of it's spread out till 2097, but will they be able to cover the debt when it's coming due in the near term? Check that out, and I will talk to you there.